Ladies and gentlemen, pause for a moment. Stop watching the charts. Stop staring at candlesticks. Stop waiting for the RSI to tell you how to feel. Stop zooming in on moving averages looking for comfort. Because none of that explains what just happened. And none of it will explain what comes next. If you want to understand this moment, you don't look at price, you look at time. Today is December 31st, 2025. Burn that date into your memory, because we are standing 48 hours away from a structural event that will permanently alter the global silver market. Not a correction, not a rally, not a temporary spike, a break. At midnight, not in New York, not in London, not in Zurich, but in Beijing, the rules of the game change. On January 1st, China's new silver export restrictions take effect. And here is the mistake most investors make. They believe markets react after events. They believe the shock comes on the announcement date. That is wrong. Markets move before the headline, before the press release, before the official confirmation. The smart money positions itself ahead of time. And the panic? The panic does not begin when the clock strikes midnight. The panic begins when institutions realize they may not survive what comes next. That realization happened today. What we witnessed this morning was not volatility. It was not profit-taking. It was not algorithmic noise. It was not fear-driven selling. It was a systemic stress event, the kind that only appears when something deep inside the financial system starts to crack. These moments are rare, and when they happen, they don't announce themselves loudly. They whisper. They show up in quiet actions, emergency decisions, movements that most people never see. And today, we saw one of those whispers. At 8:15 a.m. Eastern Time, while most of the world was distracted by routine market chatter, the Federal Reserve took emergency action. No press conference, no warning, no headlines scrolling across mainstream media. The Fed quietly injected $3 billion into the banking system. Instantly, unscheduled. And that alone should make you stop and think. Because central banks do not act this way unless something is already wrong. The Federal Reserve does not panic early. It panics late. When it moves quietly, it means the problem is already inside the building. Now pause here. Ask yourself a simple question. Why would the most powerful central bank on earth need to inject emergency liquidity at 8:15 in the morning on a Tuesday? This is not normal. In a healthy system, banks lend to each other overnight. They trust collateral. They trust balance sheets. They trust that the plumbing will function. But today, the plumbing screamed. That injection tells us one thing clearly. Somewhere in the system, a major institution woke up short of cash. And when a large institution runs out of cash before markets even open, there are only two explanations. Either risk was mismanaged, or a position moved violently against them. And given what was happening in silver, you already know which one it was. But here is where this moment becomes historic. Because while the United States was responding to stress by printing paper, China was responding by securing metal. At nearly the exact same time as the Fed's injection, half a world away, something else happened. At the Shanghai Gold Exchange, one of the largest physical silver withdrawals in recent history took place. 41 metric tons. Let that number sink in. This was not a trade. It was not paper volume. It was not accounting. This was physical silver leaving vaults. Bars loaded, trucks dispatched, metal removed from public circulation. And this is where most people fail to connect the dots. These two events were not separate.
They were not coincidence. They were the same stress response, expressed in two completely different systems. The West responds to crisis with liquidity. The East responds to crisis with inventory. The West prints digits. The East secures atoms. This is the core truth you must understand. Paper systems survive on confidence. Physical systems survive on possession. And today, confidence cracked. That is why the Fed printed. That is why China withdrew. Two sides of the same fracture. Now let's talk about why the timing matters so much. China did not randomly choose December 30th. They chose it because January 1st is not just a symbolic date, it is a hard deadline. Export rules tighten, licensing becomes restrictive, metal movement becomes controlled. After January 1st, securing silver becomes harder, slower, and more expensive. So what do rational industrial players do? They front-run the restriction. They clean out the shelves. They act before the door closes. And that is exactly what we witness today. This is why watching charts right now is dangerous. Charts show you the past. They show you a paper price that is being defended. But the real story is happening off-screen, in vaults, in loading docks, in emergency liquidity windows. And today, the first visible crack appeared. The moment paper needed saving and metal walked away. This is not speculation. This is not conspiracy. This is behavior. And behavior tells the truth long before headlines do. In Part 2, we're going to break down exactly why the Fed's $3 billion injection was not a rescue, but a warning. We'll expose who this money was really for, why this was emergency triage, and why printing dollars cannot solve a physical shortage. Because once you understand that, you'll realize the system is not stabilizing, it's buying time. And time is almost gone.
Now that you understand why the clock matters, we need to talk about what the Federal Reserve actually did this morning, because most people will misunderstand it. They will hear liquidity injection and assume stability. They will hear $3 billion and assume strength. They are wrong. What happened at 8:15 a.m. Eastern Time was not confidence. It was panic management. Let's start with a simple truth. In a healthy financial system, banks do not need emergency cash before markets open. They lend to each other overnight. They trust collateral. They trust balance sheets. They trust the plumbing. The repo market, the backbone of global finance, stays invisible. Quiet systems don't require intervention. Broken systems do. So when the Fed injects unscheduled liquidity, it means something critical has already failed behind the scenes. This was not on the calendar. This was not planned. This was not routine. This was a response to an emergency. And emergencies don't happen in isolation. They happen when leverage breaks. Here's how the mechanics work. Major banks and hedge funds dominate the paper silver market. They sell contracts representing silver they do not own. They rely on leverage. They rely on controlled volatility. They rely on confidence. As long as price remains stable, the game works. But when volatility spikes, margin requirements increase. Cash must be posted immediately. No delays, no excuses. Fail to post margin, and positions are forcibly liquidated. Liquidation in silver does not mean a gentle sell-off. It means price violence. Now connect the dots. Volatility in silver was rising. Physical silver was being drained in Asia. Export restrictions were 48 hours away. Risk models were flashing red. And somewhere in that system, a large player realized they were exposed. Very exposed. So exposed that they needed billions of dollars immediately. First, they went to the private market. They tried to borrow, but other banks saw the exposure. They saw the silver risk. They saw the leverage. They smelled danger, and they said no. That is when institutions panic, because when peers stop lending, the system turns hostile. So they went to the lender of last resort. They went to the Fed.
The Fed had two choices. 1. Let the institution fail. 2. Print the money. Failure would have triggered clearinghouse stress, forced liquidations, market contagion, especially in derivatives. So the Fed did what they always do. They printed. But understand this clearly. This $3 billion was not support for markets. It was not stimulus. It was not growth capital. It was damage control, a targeted patch to keep the system alive for one more day. And here's the detail that matters most. The Fed can solve liquidity problems. They cannot solve solvency problems, and they absolutely cannot solve physical shortages. Printing money does not create silver. It does not refill vaults. It does not reverse withdrawals. It only delays consequences. This is why the Fed's action was actually a warning signal, not a reassurance. It tells us leverage is too high, exposure is too concentrated, volatility is becoming unmanageable. And this happened before the export restrictions even began. Ask yourself this. If the system needed emergency support today, what happens when the supply actually tightens? Now consider the psychological side. The Fed hates acting visibly. It hates revealing stress. Every unscheduled move damages confidence, and yet they acted anyway. That tells you how close the edge really is. This is why smart money watches behavior, not narratives, because behavior reveals fear long before narratives change. And today, the Fed behaved like a system under pressure. Now, here's the most important insight. While the Fed was busy fixing paper plumbing, they did nothing to address the real problem. The real problem is physical availability. And that brings us to China, because while the West was printing, China was withdrawing. While the Fed swapped paper for paper, China removed physical reality from the system. And that move makes the Fed's intervention almost meaningless.
At approximately the same time, the Federal Reserve injected emergency liquidity into the U.S. banking system, something far more important happened thousands of miles away. At the Shanghai Gold Exchange, 41 metric tons of physical silver were withdrawn from public vaults. Not rolled forward, not transferred on paper, not swapped between accounts. Withdrawn, metal removed, inventory reduced, availability tightened. This was not noise. This was a signal. Let's first understand the scale. 41 metric tons equals over 1.3 million troy ounces, more than the entire registered inventory of some Western exchanges, enough silver to supply major industrial demand for months. And this happened in a single move. No gradual drawdown, no slow accumulation. One decisive action. Now here's the key question. Who withdraws that much silver, all at once? Not speculators, not traders, not hedge funds. They deal in paper, they roll contracts, they avoid logistics. Physical withdrawals of this magnitude are done by state-linked entities, major industrial consumers, strategic stockpilers, entities that do not care about price fluctuations, entities that care about availability. And that distinction is everything. Speculators ask, can I sell this later? Strategic buyers ask, will this exist later? Today, someone in China answered that question with action. They did not wait, they did not negotiate, they took the metal now. This is not random behavior. China has been preparing for this moment for years. They understand something Western markets refuse to admit. Paper prices are opinions. Physical inventory is truth. Here is how the Shanghai Gold Exchange differs from Western exchanges like COMEX. On COMEX, contracts settle in cash. Physical delivery is rare. Leverage can exceed 4,000 to 1. On SGE, physical delivery is the standard. Withdrawals are encouraged. Paper speculation is secondary. One system is built on promises, the other is built on possession.
So when you see a massive withdrawal from SGE, it tells you something extremely important. It means someone believes future access will be restricted. It means someone does not trust the system to deliver later. It means someone is preparing for scarcity. Now align this with timing. China's new silver export controls activate January 1st. After that date, export approvals slow, licensing becomes selective, priority goes to domestic use. That means once silver is inside China, it tends to stay inside China. So withdrawing 41 tons on December 30th is not coincidence. It is front-running policy. It is locking in supply before the door closes. And it tells us something unsettling. The entities closest to production and policy believe silver will be harder to get very soon. Now think about the ripple effects. Every ounce removed from the physical market increases pressure on global supply, weakens paper settlement confidence, raises delivery risk for shorts. Paper markets can absorb volatility, they cannot absorb absence. And this is where the illusion starts to crack, because the price you see on your screen assumes infinite liquidity, willing sellers, available metal. But what happens when sellers disappear? What happens when inventory is spoken for? What happens when delivery becomes uncertain? The answer is simple. Paper price becomes fiction. And this is why China's move matters more than the Fed's printing. The Fed added digits, China removed atoms. One action can be reversed, the other cannot. Let's be very clear, this was not a bullish trade. This was a defensive move, and defensive moves tell you what insiders fear. They fear supply chain disruption, export lockups, industrial shortages, strategic vulnerability. Silver is not just money, it is infrastructure, it is electronics, it is solar, it is military, it is energy transition. And China understands this better than anyone. This is also why Western institutions are nervous, because their entire silver market is built on leverage. They assume not everyone asks for delivery, withdrawals stay manageable, trust remains intact. China just proved that assumption fragile. And here's the most dangerous part. When one large withdrawal succeeds without issue, others follow. Confidence in availability erodes fast, and once that happens, paper markets unravel quickly, not slowly, violently. This is why we saw emergency liquidity in the US. This is why volatility spiked. This is why margin pressure increased. And this is why the system blinked first.
To understand why the silver market is structurally doomed under stress, you must understand one uncomfortable truth. The global silver price is not set by supply and demand. It is set by leverage, and leverage is the most fragile structure in finance. Let's strip the illusion away. When most people think they are buying silver, they are not buying metal. They are buying promises, contracts, derivatives, synthetic exposure. In Western markets, especially on COMEX, paper silver outnumbers physical silver by thousands to one. This is not an exaggeration. At peak moments, leverage exceeds 4,000 paper ounces for every 1 real ounce. Ask yourself something important. If even 1% of paper holders demanded delivery, the system would collapse instantly. That is not a hypothetical. That is math. COMEX was never designed to deliver metal. It was designed to price metal. Delivery is the exception, not the rule. Most contracts are rolled, settled in cash or offset. As long as nobody asks questions, the illusion holds. But illusions depend on trust, and trust disappears during stress. Here's how suppression works. When silver price starts to rise, large banks flood the market with paper contracts. Supply appears infinite. Price is pushed down. No metal changes hands. No inventory moves. Only perception is manipulated.
This works until physical demand enters the picture, because physical demand does not care about paper supply. It asks one question only: can you deliver? Now consider what happens when physical silver tightens. China withdraws metal, exports restrict, industrial demand stays constant. Suddenly, physical supply shrinks, but paper supply remains infinite. This creates a dangerous disconnect. Paper says abundance, reality says scarcity. And this is where leverage becomes lethal, because leverage magnifies moves in both directions. If price rises too fast, shorts face margin calls, cash is demanded immediately, positions are liquidated. This causes price spikes, so exchanges respond with margin hikes. Margin hikes are not neutral tools, they are weapons. When margins are raised suddenly, small players are forced out, speculators liquidate, and price pressure eases temporarily. But this does nothing to fix supply, it only delays exposure. This is why suppression always fails eventually. Because you cannot paper over absence, you cannot margin call a shortage. Now think back to the Fed's emergency liquidity. Why would banks need cash? Because margin calls were arriving, because leverage was under threat, because someone was dangerously short. The Fed printed to protect the paper system. But paper systems are only stable when physical markets cooperate. China just removed cooperation. Here is the structural flaw no one wants to admit. COMEX promises more silver than exists, not hypothetically, contractually. This is acceptable only if most participants never ask for metal. But when strategic buyers step in, that assumption breaks. And once the first crack appears, confidence collapses fast. People rush for exits, delivery requests rise, inventories drain, and suddenly, exchanges must choose: default, cash settle, or change the rules. Historically, they choose all three. Cash settlement is not delivery, it is surrender. It admits, we do not have the metal. That moment destroys trust permanently. This is why institutions are terrified of physical withdrawals, because metal leaving the system exposes the fraud. China's 41-ton withdrawal was not about profit, it was about stress testing the system. And the system responded with panic printing. That tells you everything. The paper-silver market can survive speculation. It cannot survive coordination. It cannot survive industrial demand. And it absolutely cannot survive geopolitical stockpiling. This is why the next phase is inevitable. Once paper control weakens, price gaps appear, arbitrage breaks, and two prices emerge: a paper price and a physical price.
There comes a moment in every manipulated market when price stops being a number and starts being a lie. That moment is called bifurcation. Two prices, two realities, one system breaking apart. And silver is now entering that phase. For decades, the silver market operated under one assumption: paper and physical were interchangeable. A futures contract supposedly represented real metal. An ETF supposedly held real inventory. Price discovery happened in one place. That assumption is now failing. You can see it already if you know where to look. Physical silver premiums are rising. Delivery times are stretching. Large bars are harder to source, yet the paper price pretends nothing is wrong. This is not stability, it is disconnect. Price bifurcation begins quietly. First, small premiums appear, dealers blame logistics, analysts dismiss it as noise. Then, premiums persist, inventories thin, delivery delays normalize. Eventually, spot price loses meaning, physical trades independently. We are now between stages 2 and 3. Let's be precise. Paper silver trades instantly. Physical silver moves slowly. When supply tightens, physical responds first. Paper lags because it is defended. Arbitrage is supposed to keep prices aligned. Buy physical cheap, sell paper high. But arbitrage requires reliable delivery, reasonable financing, and trust in settlement.
When any of those break, arbitrage dies. Today, all three are under pressure. Delivery is uncertain, financing costs are rising, trust is eroding, so arbitrage desks are stepping back. And when arbitrage disappears, prices are free to split. This is why premiums matter more than spot. Premiums represent real demand colliding with real scarcity. China understands this dynamic perfectly. That's why they removed metal, not contracts, because once physical supply tightens, paper price becomes a suggestion. Now consider what happens next. If physical silver trades at a sustained premium, minerals sell directly to end users, exchanges lose relevance, price discovery migrates, not slowly, suddenly. This is exactly how the gold market fractured in the past. London set one price, physical Asia traded another. Eventually, the physical price won. Silver is following the same path, but faster, because silver is smaller, more leveraged, more industrial. Western exchanges are trying to prevent this. Margin hikes, position limits, cash settlement incentives, all designed to keep paper dominant. But these tools only work when supply exists. When supply disappears, rules stop mattering. This is why price bifurcation is the beginning of the end, because once two prices exist, everyone knows which one is real. In Part 6, we'll step into the final phase, the last 48 hours. We'll cover what happens when physical shortages become undeniable, how markets react under time pressure, why volatility explodes, and what the system does when control is lost. Because when clocks replace charts, events accelerate.
Every controlled market breaks the same way. Not with a crash, with a clock. Price becomes irrelevant. Indicators stop working. Charts lose authority. What matters is time remaining. And right now, silver is in its final window. The last 48 hours before a structural shift are always the most dangerous, because decisions stop being analytical, they become urgent. Risk models are abandoned, rules are bent, liquidity is chased, and mistakes multiply. At this stage, institutions are no longer asking, is this cheap or expensive? They are asking, will I be able to get it later? That single question changes everything. During the final window, behavior shifts visibly. You see sudden liquidity injections, unusual withdrawals, emergency meetings, silent policy adjustments, exactly what we witnessed. Physical buyers accelerate. They do not negotiate. They do not wait for pullbacks. They secure inventory at almost any price, because once the window closes, price doesn't matter. Availability does. Taper sellers, meanwhile, become defensive. They reduce exposure, they raise margins, they limit access, they delay delivery. These are not signs of strength, they are signs of containment. This is when volatility explodes, not because of speculation, but because time pressure compresses decisions. Everyone acts at once. The system tries to hold the line. Exchanges threaten rule changes. Regulators signal orderly markets. Central banks whisper reassurance. But reassurance cannot refill vaults, and this is the key insight. Markets do not fail when price rises. They fail when delivery fails. In the final hours, trust evaporates, liquidity fragments, correlations break, assets stop moving together, silver decouples. This is when paper holders realize something terrifying. They do not own metal, they own a promise, and promises are fragile under stress. Some will rush to convert, others will accept cash settlement, most will freeze, too late to act. Physical holders, however, experience the opposite. Their asset does not depend on trust. It exists, it can be used, it can be transferred, it cannot be printed. This is why wealth transfers happen quietly, not through headlines, through positioning. The final 48 hours are not about panic, they are about selection. Who prepared? Who delayed? Who trusted paper too long?
After the window closes, a new phase begins. Price will reappear, but it will be higher, more volatile, and less controllable. History is clear on this. Every time leverage meets scarcity, scarcity wins. This is not a prediction, it is a pattern. When the dust settles, two prices may remain. Physical controls the narrative, paper becomes secondary, and the market never returns to what it was. The question now is not what will happen, the question is, where were you positioned before time ran out?